I think a large part of what happened in February is a result of the complacency that we've been talking a large part about through 2017 and the markets run-ups. I think the volatility that sort of spiked was, we were sort of anticipating something to happen at some point. But a large part, of course, driven by interest rates and the Fed and the central bankers around the world driving their activities. I think we have to appreciate the fact that we are going to see more instances of volatility spikes and environments of higher volatility that we've seen in the last year or 2 years. Right. That's more normal. Like that's what we should expect, and I think that's realistic. The second is, I think, the reality of the Fed and the central bankers' activity to go from, sort of a quantitative easing to now quantitative tightening, kind of driving the markets and taking liquidity out of the markets is going to really be a big shift, and actually could be a major part of the volatility, of the marketplace. We have underlying issues that we need to think about of some of the, as more and more money moves passive. There are ultimately areas in the marketplace that have been stuffed into passive product that ultimately are illiquid. And when you have these types of volatility spikes, it actually gets exacerbated by that. So I think that's something that we all have to recognize, that that's an area where we're very concerned about, especially in things like credit and certain areas of the marketplace. But when I look at the equity markets in general, I mean, despite all the fact that we think the volatility is, going to be a little bit more heightened, I wouldn't be surprised if we see another one of the jolts that we saw back in February again. We actually called this the last time we spoke. I thought that we'd have two in this year and two down periods, and I think we've seen one, and we'll probably see a second. But the big thing is I still think that equity markets will have a positive 12, 18-month period here. Markets could be up another 15, 20% before they really get into a recessionary period of the economic environment we're in. And so for equity investors, how should you play this? Our view is that despite the fact that equity markets will have positive returns, it's not a time to sell today, but I would be a seller into strength. I wouldn't be a buyer into strength. And so our view is we're in the late stages of this bull market. We definitely have the reality of a recessionary period coming down the pipe in the next 2 years. The activity of the Fed driving interest rates higher, will have impact on the economy. And so, for equity investors, you have to be aware of that. And so despite the fact that, we will have still positive returns in equities, we need to, in the next 12, 18 months, use that as an opportunity to be sellers as opposed to buyers. Well, I think the biggest issues, of course, are areas around interest rate sensitive assets. So as we are seeing the Fed rates increased and the central banks increasing, sort of the yield curves are shifting. I think we all have to be sensitive to what impact, assets have on duration. So as an investor in equities, I would be rotating into areas that are less interest rate sensitive overall. It doesn't mean selling dividend stocks, because there's lots of great dividend investing opportunities that are non-interest rate sensitive or less interest rate sensitive. The second thing I think is that when we get into bonds and credit, we actually believe that we're getting into the stage where you want to shorten duration, but also go up quality. So this is not a time to be taking significant risk in quality. And so our view is you want to kind of start to move to a more higher quality exposures. And there's two parts to that. One is, as you move shorter duration, having dry powder, we think that the bond market is, for the most part, run its steam. I think we're in this stage where we're going to see consolidation, we're going to see liquidity jolts, and more importantly, I think default risk will start to become more of a probability as we move into sort of a recessionary and late stage of this. So these are the things I think as investors in late cycle of markets, you always have to start concerning yourself to do the public bond market issuances favor the issuer or the buyer. And we've seen it really favoring the issuer for the last little while, and that should be very concerning for credit investors. And then, we think that there's some interesting areas like, we think Canada actually, although there's some economic challenges, I think overall, some of the challenges of whether or not we can, we've diversified ourselves properly. We actually think that the energy bull market that's starting to, commodities bull market that's starting to play itself out here could have a positive impact for Canadian stocks and for specifically energy. And I think, energy is actually starting to see a bit of a rally. We saw the most recent issuance where Shell sold off their CNQ position, and it was actually very well received for the first time in a while. And so we could see a little bit of a bump up in energy as a space to pay attention to.